we can move on now to the next session, which is going to be on carbon emissions. We're going to have two distinguished academic speakers, and the session is going to be chaired by a distinguished professional, Dr. Jenny Leivadarou. Jenny, welcome, and welcome Marcin and Luke. And Jenny is a member of the board of directors of the ELLAKTOR group. She has more than 20 years experience in the energy transition to a circular economy. Jenny holds a PhD from the Department of Applied Mathematics and Theoretical Physics from the University of Cambridge. So Jenny, the floor and your panelists are yours. Thank you.
I'm still so young. Can you hear me?
Yes.
And I'm still so young. So thank you, Professor Skiadopoulos, for the introductions, and congratulations on this very insightful conference. So good afternoon. I'm Jenny Leivadarou. Welcome to session 3 of our conference titled Carbon Emissions. It's a pleasure to chair this important session, and together we are going to explore the topic of carbon emissions from both corporate and financial perspectives. So please allow me now to warmly welcome our distinguished speakers. I will start with Professor Marcin Kacperczyk. Professor Kacperczyk is a professor of finance at Imperial College London, with research interests in the area of climate finance, financial intermediation, financial stability, and information economics. He's a research associate at the Center of Economic Policy Research and the managing editor of the Review of Finance. So, Professor Kacperczyk, welcome.
Nice to meet you, and welcome everyone. Thank you, Jenny.
Nice to meet you, and thank you for joining us. And alongside Professor Kacperczyk, we'll hear from Professor Luke Taylor. Professor Taylor is the John Neff Professor of Finance at the Wharton School of the University of Pennsylvania. His research focuses on sustainable finance and asset management. Welcome, Professor Taylor.
Thanks, great to be here.
It's great to have you here. So let's move to the first talk. It's Professor Marcin Kacperczyk, and he's entitled the talk Decarbonization Commitments. So Professor Kacperczyk, the floor is yours.
Thank you, Jenny. Let me quickly share the screen. Hopefully it's gonna be visible to everyone. So what I wanted to talk for this short intervention, the time that I have, is a little bit of a reflection on one of the drives that is actually quite important for the decarbonization, which is the commitment drive. So the short title is just broadly speaking, decarbonization commitment. So if we think about what this drive represents, it's essentially a drive that is the coalition of the willing. Is the coalition of the willing who are willing to actually take some kind of actions with the view to actually lower their emissions into the future. And the way how these coalitions have worked have largely been centered around different NGOs. So the first coalition, or one of the first coalitions, let's put it this way, was the Carbon Disclosure Project, the CDP, and that started actually in around the early 2000s. CDP was this first initiative in which companies could actually express their intent to lower emissions. And following, there has been a number of different kind of ideas around the same kind of principle. And the second, probably most prominent idea was a little bit of a spin-off of the CDP, which was the Science Based Target Initiative, or shortly SBTI. So SBTI has come to existence just around the Paris Agreement debates 2015. And importantly, both of these initiatives have been actually gathering quite a bit of steam over time. So I just want to start with some basic facts, and these are facts that are a little bit coming from the specific research I have created. The pictures are kind of pretty, that's why I could not resist the temptation to just focus on that specific universe. But I just want you to think that these are not just specific to the assets on which I have selected it. So we are looking here at Russell 3000, which is essentially a pretty big representation of large cap and mid cap stocks in the United States space. And what this picture illustrates is the idea that we have observed a continuous increase in this kind of commitments over time from different companies. And as you can see, the CDP initiative as an early one has actually probably attracted a bigger fraction of companies over time. But it is also important to recognize that SBTI has been equally actually growing fast. So these numbers end in the beginning of 2020s, but if you extended that analysis actually to the current time, these numbers would be even higher. So clearly what we have observed is the entry into the particular coalition with the view to decarbonize. And it's important to recognize that that entry is not necessarily homogeneous across different sectors. And the bottom picture here is trying to illustrate to you how this roughly varies across major kind of economic activities. And the kind of short conclusion from that bottom picture is that the typical entrants into this initiative are actually more emission intensive sectors, which to some extent, of course, makes sense because they would potentially be the ones who have more to decarbonize. But at the same time, it's also, in some sense, a good news because if you worry about who should be actually part of this kind of coalition, if you think this is going to be effective, clearly you would like to see players who are actually potentially more contributing to the global carbon footprint. So then, of course, the interesting question becomes how is it that these coalitions, in some sense, manifest themselves in terms of specific kind of objectives and goals of individual companies. So in this slide, I have summarized some of the key kind of ideas that underlie these particular trends. So when we look at most of these commitments in aggregate, what we see, first of all, is that majority of them actually have pretty short time horizon. So companies actually make commitments which are not that lasting. So this is the left picture of this slide that shows you the distribution of the commitment horizon in years. So you see there is this big left skewness in that distribution. Very few companies go more than like 20, 30 years in time. Majority of them are actually centered on less than 5 years in terms of their commitments. And in fact, if you think about what happens in terms of the steepness of the commitment, also what's important to recognize, there is a little bit of a polarization. So here in the middle picture, you see that there are companies which on one hand actually make pretty light commitments, at least kind of at face value, which is the reductions that they are actually committing to are roughly around 15-20% of their basically total. And at the same time, there are companies which are actually very radical. There are companies that decide to actually decarbonize pretty much all of their operations. So there is a little bit of the kind of separating equilibrium in the way how we can see that particular distribution. And then last point to make, of course, is you could argue what is the rate kind of per year at which actually companies abate the emissions into future in this particular commitments. You see that that rate typically is definitely closer to zero than it is closer to 100. So companies give themselves time, in a sense, on a per year basis in the way how they want to actually stage this particular activities. So now the question, of course, is, does this actually work? Because the whole idea of the commitment is to observe to what extent actually these companies are actually reducing their emission. So this is a little bit of a loaded table and no need to actually look at the specific numbers, but the ones which are in this ellipsis here kind of illustrate a little bit of the essence of what I want to say, which is, if you look at the effect of making commitments on future emissions, either 1 or 3 years into the future, there is some evidence, especially if you control for the differences across industries, that those who actually make commitments are subsequently seeing their emissions go down. So in some sense, you would think that this works. This is something that we should actually be thinking about as the model operandi for the successful decarbonization process and the transition risk that we are experiencing. But then comes another kind of idea, which is graphed here, which is the idea which kind of takes this whole world into an aggregation and ask a very simple kind of question, which is, what is it that we observe in terms of the trends in aggregate emissions relative to the trends in the commitment stage? And so what you see here in the orange picture is essentially the growth rate of commitments. So it's kind of summarizing a little bit the first picture I have shown you over time. And in the blue picture, I show you what's the growth rate in direct emissions, scope 1 emissions. And if you look at this picture, there is something that is kind of surprising here, which is we observe that this kind of does not confirm what the previous table has shown. We observe that as the commitment drive is going, actually we do not observe that the growth rate of emissions is going down. Quite actually, one could argue that by and large, in most of the periods, we observe that the aggregate emissions globally are going up. So that, of course, clearly asks for an explanation. Why is this the case that in the individual firms we observe that kind of reduction in emissions, whereas if you aggregate these firms, of course, we are not. So that, of course, tells us that there must be some kind of clearing argument that it does not exactly hold in the way how we would like to think about it. And that, of course, relates to who makes these commitments. Who are the companies that actually make commitments? And subsequently we observe them actually decarbonizing. And it turns out that the companies that are actually making commitments, and this is the kind of upshot of this table, are companies that are actually best in class within their own industries. So in this column 5 and 6, when we actually adjust for the industry or the even firm kind of level variation, you see that the higher are emissions of a given company in terms of scope 1 emissions, the less likely they are actually going to make commitments. So in some sense, this is kind of a glass half empty argument telling us that yes, there is more and more of commitments happening in terms of individual companies joining these initiatives. But if we look at the distribution of firms that make the commitments, the ones that make the commitments are the ones that actually seem to have the least problem to begin with in terms of their own kind of benchmark, which is the industry in which they operate. So that can kind of rationalize why at the aggregate level, we don't observe this actually working because the companies don't make commitments are probably the ones that grow their emissions faster than the ones that make commitments reduce their emissions over time. So that's true for CDP and SBTI. And then, of course, the question is, what are the kind of potential economic arguments that one could make to kind of rationalize a little bit of this framework? So as an economist, we of course always think in terms of expected benefits versus expected costs. And that has to also work here. Companies make commitments not in vacuum. They basically are optimizing agents by and large. And we would expect that they are gonna kind of compare what it is for them to gain versus what it is for them to actually lose. So clearly one could make an argument that there is some kind of notion of signaling of climate intentions, potentially the financial benefit of making commitments in terms of the lowering cost of capital. But at the same time, you could argue that there are also costs that potentially make companies not want to make this kind of commitments. One are, of course, the direct cost, which is that requires some kind of action on the side of the companies. But the second one are also reputational costs, which kind of relate to the idea that that you are actually not going to deliver on what you are promising to your shareholders or to the world more broadly. So this is what I wanted to kind of highlight a little bit in my remaining few minutes I have. So there are kind of two ways in which you can think about this cost. So one way in which I have looked at this kind of idea is to think in terms of how it is that companies actually make the commitments more specifically. And this basic principle in which commitments are made is that at a given point in time, companies promise to reduce their emissions in a particular time period, as I have mentioned. But the important aspect of that argument is that they actually choose the date from which they are actually reducing these emissions. This is what we call actually the baseline date. And oftentimes what happens, this baseline year is the year actually before the commitment is being made. In fact, companies have a full discretion to go as much back in time to say from when it is that we should be actually calculating this decrease. So now the interesting question is, how is it that companies actually choose that date? Is there something random that happens in this process, just a pure kind of mechanical choice? Or is there actually something that potentially could tell us about the incentives of these companies in terms of the commitments themselves? So this is the kind of result that tells you something potentially interesting, which is if you look at the narrow window around the time when companies make a commitment and you ask yourself a question, what base year they actually choose as the year from when they are going to start the decarbonization, you find that on average, companies choose the years when their emissions were on average higher than in any other year surrounding that choice. And even more so for companies that have higher emissions. So given that you actually know that this base year is actually backdated, that tells you that in some sense, companies are sandbagging. They are already accounting for some of the emission reduction that they have achieved prior to making the commitment. So that makes it easier for them to actually deliver on what commitments they are making. They strategically choose that date so that they know that the curve is actually less steep than the one they are actually committing to. So that's kind of one argument which I think is quite interesting in this discussion. And then the second argument is a little bit of an exposed reconciliation. How is it that we have delivered on these commitments? So this is the picture that gives you the idea in a very simplistic way, where we are taking the rate of the commitment per year that companies commit to, and we are comparing it to the year per year reduction in emissions that we observe over time, over the time period of that commitment. So this is kind of subject to a caveat that we don't always reach the end year. So the implicit assumption is that if you want to decarbonize, you want to follow some kind of linear decline kind of path. If this is not the case, maybe that analysis would have to be qualified. But what comes kind of striking out of this analysis is that a majority of companies, if you take this framework, actually fall behind on their promise. So the rate at which they're actually decarbonizing their operations is lower than the rate that they have actually promised to go at, given the commitments that they have made. And you see that there is a lot of actually tails also to the right. So what these pictures are essentially telling you is the difference between those rates of decline in terms of realized emissions versus the promised kind of implied declines. And then you can start asking questions, what's the average kind of miss by these companies? Here is one way to view it. This is a summary of that gap by sectors. And you see there is quite a lot of cross-sectional variation across sectors. And again, industries like communication services, materials, IT are the sectors where they are missing the most. The lowest failures you see in terms of utilities, industrials, and financials. So clearly there is some kind of potentially mechanical difficulty how to decarbonize, or maybe the incentives are kind of differently placed across these sectors that actually go into this process. This is kind of the time series on average, how these misses look like. Good news on that maybe is most of the years, these misses have been actually going down over time. So that may suggest that actually companies that make new commitments are taking these commitments more seriously, in a way that the way in which they miss the promise is actually on a lower margin than the way that they actually did it in the earlier period. And then here is the last kind of picture I want to show, and I will finish, which is how is it that we can think of this from the perspective of some kind of risks of not delivering. And there are a couple of points here in this picture that tell you that. So some of the striking facts that you observe very differently is, for example, companies that grow faster are more likely to miss on average. So that tells you that this kind of unpredictability of the future operations makes it difficult for companies to actually anchor how well they are going to deliver on what they are promising. Companies that make the promises for shorter term are also the ones that are making bigger misses on average. So clearly, time is somehow helping these companies at least exposed in the way how they are able to manage these emissions. And then dealing with scope 3 emissions seems to be actually a challenge. So if you have to think about scope 3 upstream emissions, that's where the misses are potentially bigger. No big differences in terms of ROEs, market cap, or book to market ratios. So just to summarize, I think there is a challenge. There is a promise in terms of a great framework of commitments that we can embrace. But at the same time, the challenge is that these commitments don't always deliver basically what we are looking for. And I think that kind of calls for a little bit of a second generation of pledges in the way which we will try to tie it more closely to what it is that companies actually do and how they actually formulate these pledges. So in some sense, the one-size-fits-all framework may not be necessarily the best framework with which we are going to work. So let me stop here, and I look forward to Luke's comments.
That's fantastic, especially the observation about the baseline year. So thank you very much for this very insightful talk. And now we're moving to Professor Taylor, who is going to discuss the US corporates' future carbon emissions forecasts and their cost to society. Professor Taylor, the floor is yours.
Great, thanks. It's an honor to be here with all of you, and hello to my friend Marcin. The big picture question here is how valuable are firms to society? We're all used to measuring that in terms of companies' market values, but of course there are other parts to firms' value to society. Firms provide value to their customers. We call that consumer surplus. They provide value to their employees, to the government through the taxes they pay, and so on. Now, importantly, the value of a company to society should include the value of the externalities the company produces, and there are several positive and several negative externalities that companies generate. Among the negative ones include externalities from carbon emissions, from toxic pollution, and so on. So more narrowly, the question we're trying to answer in this paper is how big are corporate externalities? The answer to that question matters for policymakers who are designing kind of taxes and regulations. The answer should matter to companies who are managing their sustainability efforts and who are trying to manage certain risks. And they can matter for consumers and investors who care about things like sustainability when making their choices. The answer also is relevant to this debate over the famous Friedman doctrine. Milton Friedman famously said that the social responsibility of business is to increase its profit. That doctrine becomes controversial if these externalities are large. And in this project, we're trying to figure out how large are these externalities. Now, measuring externalities is difficult. We have to think about short-term and long-term effects, direct and indirect effects. There are many stakeholders involved. So we're going to focus on one specific externality that's relatively easy to measure. So we're focusing on the carbon externality. So we're focusing here on damages coming from greenhouse gas emissions. What makes this a relatively easy externality to measure is that the hard work has been done for us. The really hard part of this exercise is putting a number on the social cost of carbon. So we're going to take the state-of-the-art numbers off the shelf and use them. So what we do in this project is we try to quantify the US corporate sector's carbon externality. We do that using a new metric that we call carbon burden. This is the present value of social costs coming from future carbon emissions. Why focus on the future? Well, one reason is if you want to know how bad climate change is going to be, well, that's going to depend crucially on where emissions are going into the future. We analyze carbon burden at the level of kind of the aggregate US economy, and then we drill down to the industry and ultimately the firm levels. Here's a summary of what we find. The headline result is that the carbon burden is huge. We estimate it in one baseline specification to be 131% of total corporate equity value. So what we're saying is that the present value of damages from greenhouse gas emissions is even bigger than the present value of dividends to shareholders. And that was surprising to us. You should think of there being a confidence interval around this estimate. It's probably a pretty wide confidence interval because all the inputs we use to our analysis come with quite a lot of uncertainty. Unfortunately, we don't have the data we need to construct those confidence intervals, but these numbers should be kind of interpreted with caution. So then we showed that if we could hypothetically reach the Paris Agreement goals set under Biden, that would cut the US carbon burden by between 20 and 30%. But unfortunately, predicted emissions cuts are falling well short of the Paris goals. So then at the firm level, we show that carbon burden exceeds market capitalization for kind of a striking 77% of firms that together make up about half of total stock market value. That's if we look at a measure of total emissions, so that would include scope 3. The number drops to a still non-trivial 13% of firms that make up 9% of total market cap if we only look at their scope 1 or direct emissions. We show that the largest emitters today have greater predicted emissions reductions in the future, so much so that the top 30 emitters today account for all the predicted decarbonization in the US economy. Other firm characteristics like investment rates, climate scores, and book to market, these also help explain the cross-section of predicted emissions growth rates. And we showed that carbon burden varies a lot across sectors. It's very high among utilities and energy firms. It's low among financials and healthcare. That's what you get if you look at direct emissions only, but I'll show you that picture actually changes in interesting ways if you include scope 3. Okay, so the details. Carbon burden. Again, it's the present value of social costs from future carbon emissions. Why should we care about future emissions? Well, let's do an example. Here are two of the largest scope 1 emitters in the US. I'm plotting their historical emissions. Which of them has the larger carbon externality? Well, if you only look at their past emissions, you might say American Electric Power has the higher carbon externality. But you would actually reach the opposite answer if you looked at data on their forecasted future emissions. AEP is forecasted to cut its emissions a lot. NextEra is not. So much so that actually NextEra has the bigger carbon burden by more than a factor of 2. So again, the point of the example is to show that it's important to think not just about where emissions have been recently, but where they're going in the future. So how do we compute the carbon burden? We use this simple formula. If you know the formula for discounting future cash flows, this is a very similar formula. We think tau years out into the future, and for each of those future years, we need to figure out C tau, that's expected carbon emissions tau years from now. We need to multiply that by SCC tau, that's the social cost of carbon tau years from now. Conceptually, this is the dollar cost to society coming from the emission of 1 extra ton of carbon tau years in the future. The social cost of carbon is a net present value of those costs to society starting in year tau and going out all the way into infinity. We're going to use the most recent SEC forecasts coming from the EPA. You should think of these numbers as coming from a very big interdisciplinary research effort, subject to peer review. The social cost of carbon starts around $200 per ton of CO2 and increases into the future. The third big input here is our discount rate, rho tau. We're using values between 1.5% and 2.5%. Why these numbers? Well, at the end of 2023, the yield curve, so interest rates, were pretty flat, around 2%. And then we take our cues from the climate finance literature and adding, we try a small positive and a small negative risk premium on top of those risk-free rates. So conceptually, carbon burden can be compared to market value when our horizon, capital T, is infinite. Market value, of course, is the present value of dividends to shareholders. Carbon burden is the present value of social costs from future emissions. Carbon burden market value is owned by shareholders. Carbon burden is, in a sense, owned by all humans, including those outside the US, including those not yet born. So we're going to start at the level of the aggregate US. We're going to set C tau equal to forecasts of total US greenhouse gas emissions by adding up the various types of GHGs. These forecast data come from the US Environment Energy Information Administration as well as the US EPA. They give us forecasts through 2050. To go beyond 2050, we're going to project a negative 0.5% growth rate into the future. That's kind of negative 0.5% is the growth rate that we're expected to see through 2050. So we just continue that forward. What does that look like? Here are those forecasts of US carbon emissions. They're coming down, flattening, and then we start applying that negative 0.5% rate. When we feed this forecast through that simple formula, here are the estimates we get of the total US carbon burden. In panel A, we're showing those in trillions of dollars. The different columns are under different assumed discount rates, and we're showing answers for different horizons. I'm going to focus on, what happens if we consider all future years and a 2% discount rate. We estimate an $87 trillion carbon burden for the US. To put that very large number into context, we compare it to the value of equity for all US companies. Carbon burden as a fraction of that corporate equity value is down below. In our baseline estimation, that number is 1.31. So we're finding carbon burden is even bigger than the value of all companies' equity in the United States. So we're finding that this externality is indeed very, very large. A few notes here on interpreting these numbers. First, responsibility for the carbon burden is inherently shared, not just by corporations, but also by households and our politicians. Number two, firms with large carbon burdens are not necessarily undesirable from a social point of view because these companies also can provide society with large benefits. You should think of the carbon burden as measuring the externality gross of any carbon tax. And finally, if there were a large carbon tax, that would not necessarily wipe out equity market values because some of the incidence of that carbon tax would fall on consumers, especially when demand's inelastic. That's at the aggregate level. Now we want to drill down to the firm level. To do that, we're going to use data on forecasts of firms' future emissions. These very interesting data come from MSCI. They provide forecasts for individual firms' future emissions broken down by scope every year from 2023 to 2050. To extend it beyond 2050, we're using the same approach as before. How did they do this? Well, for about 800 of these firms, they have emissions targets. These are the commitments that Marcin just discussed. For the firms that don't have a target, MSCI is assuming their emissions grow 1% per year. For firms that do have targets, MSCI is providing us with two types of emissions projections. The first they call target-based. These takes the firm's targets or commitments at face value. We don't really rely on those numbers. Instead, we rely on MSCI's credibility adjusted forecasts. These are a weighted average of the company's target and this 1% emissions growth scenario. MSCI puts more weight on the target if it considers the company's target to be more credible. And it's judging credibility based on a whole host of data that I won't jump into. So we use those firm level forecasts to estimate a carbon burden for every single firm. And here I'm comparing those firms across their industries. And what the numbers here are the ratio of carbon burden to market cap for the typical firm in each of these industries. For the first column, I'm looking at scope 1 emissions only. There we find the typical energy firm has a carbon burden about 3 times its market cap. For the typical utility company, it's approaching 7 times market cap. For financial firms, though, it's very small. You get a rather different picture, though, if you sum up scopes 1, 2, and 3 emissions, understanding there's a double counting issue we should worry about. Now the numbers are much, much bigger. And one interesting change that comes out here is with financials, now we find that financial companies have very large carbon burdens. This is at the industry level. What about at the firm level? There we find there's huge dispersion in carbon burdens across firms. For many firms, carbon burden is extremely small. But for some firms, carbon burden is quite large. For example, if I take scope 1 emissions, for many firms, carbon burden over market cap is above 1. So these are firms with carbon burdens exceeding their market cap. With scope 1 emissions, we find that's true for 13% of firms. If we look at the sum of scopes 1 and 2 and 3, we find that for 77% of firms, carbon burden exceeds market cap. So for some firms, these carbon burdens are very, very large. Why so much variability in these carbon burdens? One reason is there's a lot of variability in firms' forecasted emissions growth. For some firms, MSCI is forecasting that emissions go to 0. For other firms, it's forecasting positive growth. What types of firms are expected to grow their emissions versus cut their emissions? The main pattern we see in the data is this one. We're seeing that the largest emitters today have the lowest forecasted emissions growth rates. So to see that, here are how much companies are polluting today. Here is the forecasted cumulative growth rates in emissions, and it's a very strong negative relation. That pattern is so strong in the data that the top 30 emitters today are expected to account for all the decarbonization in the entire economy. To see that, I'm plotting here the sum of scope 1 emissions. The green line shows all companies in my sample. The drop in this green line is how much decarbonization is going to happen in aggregate. This dashed line shows the same thing, but I'm only looking at the 30 largest emitters today. The orange line moves in parallel with the green line. That means all the decarbonization that's going to happen in aggregate is going to come from just the 30 largest emitters today. That surprised us. So to conclude, three takeaways. The first, what is carbon burden? Think of it as one dimension of firms' value to society. It's the present value of social cost of firms' future carbon emissions. We're finding that this burden is very large, 87 trillion, or 131% of companies' equity value in 2023. And one last other interesting fact we're finding here is that the largest emitters today are playing an outsized role in future decarbonization at the economy level. And I'll stop there. Thank you.
Well, thank you both for this very interesting discussion. We're going to the third part of our discussion, which is the Q&A, and we have already some questions for you. So, Professor Kacperczyk, I'll turn to you now, and I will ask you, you showed some graphs that end in 2020. Are the carbon commitments and the actual emissions following the same trends after 2020?
Well, so in aggregate, there is a little bit, of course, of a blip, which is the COVID time. So that's always a challenge because essentially you need to ask yourself a question, was this really an intent of the firm or was it something that was exogenous to the firm's activity? So if you actually exclude the COVID-related events, which kind of, I would argue, just mechanically remove the next 2 years after that particular picture I showed you, the answer is roughly yes. That has not yet changed much, but as I said, the quality of commitments has been improving, but not enough to kind of totally overturn that particular picture.
Thank you very much. And I'll turn to Professor Taylor, and I have one question from the audience and one from my side. The audience is asking, now that the carbon commitments are not that strong, so some companies can get away with not making any commitments because we're changing the regulation again. Do you think that this trend is going to be more prominent about the companies that make commitments, or the value of the social burden versus the actual the emissions that they have? And my question is, do you think that only if carbon price meets the social burden price, will they actually take serious action to cut down their commitments? What is the carbon price that they should pay to understand?
Well, starting with that last one, many economists would say the socially optimal carbon tax is the one that's set equal to the social cost of carbon, which is, according to the EPA, around $200 per ton of CO2 currently. To the first question, I like the first question too, because all of our analysis was done at the end of 2023. And a lot has changed in the world since 23, especially in American politics. If anything, when I think about the changes in American politics, those changes would probably increase the carbon burden above what we estimate, because probably these political changes are going to increase the amount of carbon that we're going to be putting into the air, even beyond the forecasts that were made in the year 2023. So if anything, these political changes, sadly, strengthen our paper's conclusion that the carbon burden is very big.
Well, thank you both for this very thought-provoking discussion. This concludes session 3, and now I'll give the floor to Professor Skiadopoulos. Thank you very much.
Thank you.
Thank you.
Thank you, Marcin. Thank you, Luke. Thank you, Jenny. Very stimulating. And actually, your session is going to tie very nicely with both the following panel discussion as well as with the last section on climate change risks, where we're going to have Johan Strobel and Mika Morse talking more about climate change risks. So thank you once again.